shortly. While we wait, please take a moment to fully prepare for the presentation. First, make sure your audio is working. You should be hearing sound now. Also, please remove all distractions. The information we will be sharing is very important, and we want to make sure you get as much out of it as possible. And finally, be sure to have a notepad and pen so that you can easily take notes and write down references that may be discussed. Thanks again for trusting Trade Maestro with your trading education. We will begin shortly. For thousands of years, if somebody wanted to learn a new skill, maybe learn to make boots or horse saddles, how did they learn that skill? They studied with a master. Trade Maestro builds on this tradition, the relationship between the mentor and the apprentice, but we do it all online. The term maestro means master or an artist of consummate skill. And that's what a trade maestro is. It's a person who has mastered the art of trading. I didn't want to create just another stock market trading company that sells classes. I've done that, and I don't think that's in the best interest of my apprentice. I want to walk him through the process of becoming a great trader, and you don't get there with information overload. You get there by doing it, by getting your hands dirty, by putting into practice. That's the only way to build a new skill.
I love how Jeremy teaches. I love the fact that he teaches things in such a real, practical way.
And he made me realize that I can do this.
I remember when I first started my trading journey, and let's just say I blew up at least 2 accounts.
I know this model of learning to trade works. I've had the opportunity to work with people from over 80 different countries.
And I was skeptical at first. I was kind of like, okay, are you sure about this?
I was always chasing stocks. I would always chase the next top thing and never had an opportunity to get any profit from it.
I've helped people with trading accounts that are just a few dollars, and I've helped people with trading accounts that are over $1 million.
These courses give me a much wider perspective on what is really possible.
And what Jeremy does so well is that he breaks it down in a simple form so it's easy to understand.
They're just regular folks, and if I can teach them, I can teach you.
I didn't want to let someone else tell me what the play was, and I just followed their lead. I wanted to learn it for myself.
My greatest joy is when somebody that I have taught over the last decade, they reach out and they say something like, you won't believe it, but I actually have people that are asking me to teach them how to trade. Is that okay? You think I can teach them?
Working with you taught me that, stocks go through ups and downs pretty regularly and pretty predictable.
The portion that my husband has now been able to take over and own has outperformed the market and is doing better than the rest of our retirement. It is totally life-changing.
Just to think that I touched people, I taught them to do something, I influenced a generation of traders, and now they're taking it forward and they're influencing the next.
At the end of the trade, I ended up making 140%.
It just gives me so much delight and joy knowing that I can still do something with my financial future.
This is not something that's only for other people. I can actually become financially independent.
Not only allow me to make better trades, more lucrative trades, but have more confidence while I trade.
This Trade Maestro membership is excellent because it's got something for everyone. If you're just starting out, or even if you've been trading for a while, you'll find something you like. You need to get enrolled right now. It's affordable, it's comprehensive, and it's risk-free because you can cancel anytime if you decide you don't like it. So if you want to learn to trade the stock market, or if you're looking to take your trading to the next level, you need to get enrolled as a Trade Maestro member right now. The following presentation is for educational purposes only. All examples and analysis are intended for these purposes and should not be considered as specific investment or trading advice. All examples are for the purposes of teaching and are not intended to suggest future results. The risk of loss in trading securities, options, futures, forex, and cryptocurrencies can be substantial. Individuals must consider all relevant risk factors, including their own personal financial situation, before trading. Options, futures, and forex are considered more sophisticated investment vehicles due to high leverage and are not suitable for all investors. Well, good morning. Good morning. I hope everybody's doing fantastic today. I guess for some of you, especially those of you over on the East Coast, it is afternoon. Welcome to the afternoon hour for you. But for the rest of the country, it's either morning or right in the middle of the day. And it's great to be with you today. I'm Jeremy Whaley, founder of Trade Maestro, and I am looking forward to jumping into what we're going to call day number 10 of our Pick Winning Stocks Challenge. You got to stay centered on the video here. Pick Winning Stocks Challenge, day number 10. So we've been working through the process. We're right at the halfway point. And today is going to be a major one because I'm going to share with you how you beat the market and how you beat the so-called professionals we've been building to this point. And today is a critical breakthrough day. So before we get started, I got a couple of things for you over in the chat. There's a link to some resources, specifically our Trade Maestro website, and a download for the Ultimate Trading Cheat Sheet, which you're going to want to have because it kind of puts everything into one PDF. Also, if you don't mind, tell me over in chat where you're coming in from. It'd be fantastic to hear from you. We've already got Galt0220, which I think is Greg, because it says Greg from Chickasaw, Oklahoma. So welcome, Greg. He's the only one so far who's told me where you're coming from. So Greg, I had to give you a shout out there. And I want to make a quick announcement that Monday, we kind of got this whole thing going now. We're in the middle of our third week of doing our live streams every day here at Trade Maestro on the channel. And Monday, I'm going to make a pretty big announcement. So you're going to want to be here. And I'm going to go ahead and tease it and tell you that the announcement is going to be about what is the future for the channel, where we're going to go with it, and what these daily live streams are going to look like after the Pick Winning Stocks Challenge. Because the Pick Winning Stocks Challenge was just kind of a, hey, let's do this every day for 21 days and see what happens. But I do have a future for this, do have a vision for it, and I'm going to start sharing that with you on Monday. At least that's the plan. And hopefully we're going to get the other graphics and upgrades that I started working on over the weekend. Hopefully we get all those maximized as well. If you weren't here on Monday, we had a complete train wreck. It was a disaster. Everything fell apart. But we're here now. We're back to the old system. And hopefully we'll get all the new stuff working as well. And that's important because as we're trying to share charts and stuff, it's better to have the higher resolution so you guys can really see the details. So that's why it matters. All right, let's jump in. Let's start talking about our market overview and taking a look at what is going on. It is a mess out there, or is it? It is a little bit of a mess. It's doing exactly what I said yesterday, though. If you were here yesterday, you heard me talk about it. You heard me say that we are starting to build our major support right here, right around the 38,000 mark on the Dow Jones Industrial Average. So that's where we are. We saw it all day yesterday. What we saw is we saw rallies and sell-off and buying and selling. A lot of volatility. That's kind of the key. That is the theme right now, is lots and lots of volatility. Volatility is not a bad thing. It's just a different market condition. Just because you have volatility doesn't mean that things are inherently bad, doesn't mean things are going downhill. It just means that it's different. It's a different market condition, so we approach it differently. Currently, as we speak right now, if you just look at the day-to-day movements, Dow Jones is up 556 points. Some people are like, oh, yeah. Other people are like, why? Why is it going up? It should be crashing. Or maybe it's just exactly what we thought it needed to do. If you remember yesterday, I shared with you that during extreme periods of volatility, such as 2009, if you were around during the 2009 crash, actually it was 2008 moving into 9. If you were around during that period, then you remember that we had a very similar situation where we'd sell off 1,000 points, and we'd rally the next day 800 points. And it was just back and forth, back and forth. And that's a lot of the similarities of what we're seeing right now. The difference is I'm not sure we have the full systemic crisis brewing. I think there's a lot of other things that are stronger in the market right now and in the economy. But as we said yesterday, we had a big rally, big rally. And when I talk about rally, I'm not talking about just recently, talking about the big picture, which I can't seem to, there we go. Couldn't get my chart to move. This move from the end of 2023 to the peak up here at 45,000, that was a 30% move basically, and it's not sustainable. So what happens when you have a big move like that is you have a big pullback, and this is one of the major support levels that we would pull back to. It's also Fibonacci level. There's all sorts of reasons that this is where we're finding support. So I do think this is a correction, not a crash. Correction, not a crash. Take a look over here at the S&P 500. Same thing, same song, different verse, but it is absolutely the same song. And we are finding support here just above 4,800, which is a known pivot area, and it's a pretty logical place. Same thing's happening over here on the NASDAQ. This is the NASDAQ index, the overall composite index that we're looking at, and it's up 272 points right now. Some of you will look at the NASDAQ 100, which is the QQQ basically. And when we look at NASDAQ futures, that's generally what we're referencing. So NASDAQ futures up 320 because that's the NASDAQ 100. But what I'm looking at here is the NASDAQ composite. And it is finding a major pivot, major support at 15,373. So all of that is working kind of like we thought it would be, moving towards building this base here. And then the question is, will we drop down and hit some lower supports, or is this it? It's going to be hard to say right now. We don't know what additional news events will come out that will sway the direction a little bit. As I've been saying for the last week and a half, news comes with a direction, not a price. We have seen that now. The value, the price, if you will, is determined by the people that are trading, not by the news. And it's going to be defined by these pivot areas that we now know as support and resistance. So that is your big picture market update. It is Wednesday, and it's Wednesday at noon. So we're pretty much right smack in the middle of the week. And that's where we are at this point. Taking a look here, you see the 10-year treasuries are rising just a little bit. It's just a point of interest. Nothing major to report there, but let's see. Crypto, I'm not sure I need to go down the crypto rabbit hole right now. Bitcoin and all these guys are trying to find some support, but we just haven't quite put a bottom in yet. So I'm not sure there's a whole lot to report there. If you got any questions of the big picture market overview or anything you'd like to have discussed, absolutely type it into the chat. Do that right now. And if you have not already liked and subscribed, please do so, especially those of you over on Rumble. Now, I want everybody to do it. I want those of you on YouTube to do it too. But on Rumble, since I didn't just start this channel, I just never used it. I never did anything with it. I had 5 followers a week ago, and we've tripled that. But I can't get a custom URL until I have 20. So I think I am 4 or 5 short. Let's see. It looks like I got 16 right now. It's not very many. We have consistently more people in the live stream than we have followers on Rumble, which is kind of funny. So, if you're over on Rumble, if you haven't liked and followed the channel yet, please do so. And we're going to be very intentional about building that and getting lots and lots of content over there. So please, by all means, do all that stuff because it's just the right thing to do. It's just the right thing to do. All right, let's jump into day number 10 of the Pick Winning Stocks Challenge. And this one is called How to Beat the Market and the So-Called Experts. Now, that sounds either redundant, maybe common, like that's what everybody says, or it sounds super exciting. And this is super exciting because it's not like most of those YouTube videos you see out there, how to beat the market, let's do this. No, this is the actual formula. It's a real formula. It really will work, and this will transform. I mean, everything I teach, I think, transforms your trading career, but this will transform the way that you interact with the market. So let's do a quick recap first before we get into that. Here's what we've talked about. We talked about strategy this week, and that is how we play the market. We looked at the two basic types of strategy, buying long and selling short. And then yesterday we got into kind of the structure of it, trading from pivot point to pivot point. Now we're going to go a much deeper step here, and I'm going to ask the question, what is the holy grail of measuring market success? Any idea what the kind of the ideal measurement is, where we say, if you can do this, you are successful? Now, some of you are going to say, if I make profit. And that is true. I mean, that's a way of measuring market success. But on a broad term, from a broad standpoint, the holy grail of measuring market success are the benchmarks. What are the benchmarks? I'm so glad you asked that question. The benchmarks are the indices. It's the things that we compare everything to. The S&P 500 is the biggie. Now, the Dow Jones is also a big one. It's been around the longest, but you have to realize the Dow Jones Industrial Average is only 30 industrial stocks. It was created in the late 1800s by Charles Dow and Edward Jones, hence the name Dow Jones. And it was a good measurement of the economy at the time, a good measurement of where things were going, but a much better measurement, and really the primary benchmark today, is the S&P 500. So that's the big one. And then you have all the other S&P indices, which are, you know, like you have the small caps, the S&P 400, you have the 600, you have all the different variations, you have the emerging markets, you have the individual sector fund indices, all the different indices that S&P puts out. Those are the benchmarks. So whenever you look at a so-called professional and they say that they're a fund manager, they're going to be managing a basket of securities, and they're measuring to the benchmark that the S&P puts out, that Standard & Poor's puts out. Okay, so if they're measuring emerging markets, they're measuring against the S&P emerging markets benchmark, and on and on. That's what the benchmarks are for. Now, there are other indices, such as the Dow Jones, such as the NASDAQ, all these other indices, the Russell 2000, etc. They are benchmarks in and of their own right. But again, they're not the primary benchmark. The primary benchmark is the S&P 500. So here's the goal. The goal of every fund manager is to beat the benchmarks. That's the goal. The misnomer that they don't really tell you is, what does it mean to beat the benchmark? And here's what it means. You ready for this? I'm going to show you. This would beat the benchmark. This would beat the benchmark. This is 2020, by the way, so this was a very precarious time in market history. And I used for a lot of these examples this time frame because it was such a scary moment for people. But you notice my white line. My white line is the definition of beating the S&P. It means we're doing slightly better than the S&P. And you notice in this bear market, which was just an absolute devastating crash that we had in 2020 during COVID, all we had to do to beat the benchmark was not lose as fast as the benchmark. But it didn't mean you stopped the pain. It didn't mean that you avoided drawdown. It didn't mean that you did anything spectacular. You just simply beat the benchmark. That is the definition of beating the benchmark. Did we do slightly better than the benchmark? Sounds simple enough, honestly. And frankly, I think it is. But what do the professional results say? Well, you've heard me say this, and I'll keep quoting it probably till I die. 93% of fund managers underperform their benchmark. What? 93%. Now, this is published by S&P. They put out a study every year. It's called the SPIVA study. The numbers do change every year. They shift up and down. So just depending on the year, it might be 90%. Some years it might be 95%. They underperform the benchmark. That means you need a top 5, 6, top 7% money manager if you're going to beat the market with a professional money manager. Just let that sink in for a minute. If you're watching this right now, unless you've been following me forever and you're trading your own money already, if you're watching me right now, the odds are you have a professional, I'm using air quotes, a so-called professional money manager that you pay generally 1% to 2% a year in fees, whether you realize it or not, you're paying them. So in a $100,000 retirement fund, 401k, that's $1,000 to $2,000 a year that you're paying them to manage your money. And the benchmark is to beat the S&P 500. And the statistics are 93% fail. That's why you feel broke, because the so-called professionals are also what we should call failures. They're not doing a good job. They can't match, much less beat the S&P benchmarks. Now, this particular quote, the 93%, that's for the broad market funds that are compared against the S&P 500. There are other S&P benchmarks that have different sectors, different benchmarks. There's others that over the same time period have as much as 97% of the so-called professionals cannot match their benchmark. They underperform the market consistently. Now, what does that mean? It means it would be better for you and better for anybody to simply buy the index fund and walk away. It would be better if you just bought the index fund and left. You would do better than 93, 95, 97% of the so-called professional fund managers. Well, there you go. There's your gift right there. So how do I match the benchmarks? Here it is. This is the easy, guaranteed way to match the benchmark. And the answer is we're going to trade the related index ETF. This is so simple, anybody can do it. I mean, this is so simple, I could literally teach an 8-year-old to do this. I could teach a 6-year-old to do this. I mean, just keep going. If they can talk and push a button, they can do this one. You can match the benchmark. It's as simple as trading the related index ETF. And in doing that, you can, number one, save all those management fees and beat the professionals. My job is done. I've given you the answer. Okay, now I could sit here and go through all the research and show you all the data to support this statement about how bad the professionals are, but it's not worth our time. Just that one statistic is all you need. SPIVA, if you want to go research the SPIVA study, go do it. I don't care. This is the facts. The facts are the professionals stink at their job. They are woefully undereducated. They're woefully unprepared. They're woefully underperforming. And you have more power and more potential in your pinky than the entire professional industry, in my opinion. Okay, now, they may take me off YouTube for saying that. I don't know. But that's just the reality. So let's break this down a little bit. What is an index fund? What is an index fund? An index fund is going to be an exchange-traded fund. It's called an ETF, exchange-traded fund. And it trades like a stock, but it's not a stock. It is instead a fund. Now, what do I mean by that? If you've been managing some form of retirement, you've got some, money in a 401k or wherever it is, and you keep putting your money into mutual funds, that's a fund. A mutual fund is a collection of securities. So you'll have Apple, Microsoft, IBM, all the different stocks. You'll put it into a fund. You'll pool all the people's money together that are invested in the fund, and you will buy as much of those securities as the fund can afford. That's what a mutual fund is. It's mutual because more than one person is buying into it. And this has been the staple of retirement accounts for decades. Since probably since the 40s, maybe since the 30s. I don't know, however long they've been around. But for 100 years, this has been a staple. In the late 1980s, I may be off on that date, but roughly the late 1980s, somebody came up with this brilliant idea and said, what if we created the idea of a fund, but it trades instead of having, these load fees to get into it, these load fees to get out of it, instead of having a minimum time that you have to be invested, instead of having a certain time of day that you can close the trade and you can actually get out of the fund, instead of having all these rules, we're going to trade this fund exactly like a stock. And the exchange traded fund was born. That's what an ETF is. An ETF is just a fund like a mutual fund, but instead of trading and working like a mutual fund where you have to go through a broker and you have all these rules and regulations to go with it, instead, the ETF trades like a stock. You can buy it long, you can sell it short. You can buy and sell multiple times during the day. There's no boundaries, there's no framework for when you have to buy and sell. If you're an options trader, you can trade options on ETFs. There is a million areas of flexibility that make the ETF radically more practical and beneficial than the mutual fund. And yet, percentage-wise, most Americans, because they are uneducated in this area, they are still letting retirement fund managers put their money into mutual funds, charging lots of fees and not matching the benchmark. It's really a tragedy. It's one that should be put on every billboard in America. And when you walk into a financial planning office, the first thing they should say is you need to know more than 90% of us fail at our job. We stink. That should just be disclaimed, but it's not, which is why I have a job. It's why I have a business, because what I do is I teach people like you how to do the job that the so-called professionals can't do. And the first step in doing that is what I've just laid out. We're going to work with exchange-traded funds. It's a fund that trades like a stock, but it's a fund. When we look at the index part of it, the index means that it matches the holdings of the stocks in the index. Now, this seems logical to me. Index funds have been around for a while, been around for a long time. What is illogical to me is why every fund manager would not just trade index funds. Since they keep falling short of the benchmark, why wouldn't you just trade the benchmark? But they don't. What is an index fund? An index ETF is going to be something like SPY, ticker symbol SPY, that trades like a stock. It's the heaviest traded ETF on the market. More volume, more everything than any other ETF that's out there. And what it does is it's a fund, it's an ETF fund that holds the stocks of the S&P 500 exactly in the same proportion as the S&P 500 index. Now, if you didn't know this, you can't trade an index. I mean, you can trade it via futures or derivatives, but you can't actually trade the index. When you turn on the TV at the end of the day and you hear the news say, the S&P was down 39 points today. The S&P was up 53 points today. When you hear those news reports at the end of the day, you can't just go trade the index, because the index itself is just a measurement. It's like an indicator, okay? You can't just trade that. What you have to do is you have to trade an asset, and the asset that is tied to the S&P 500 is the ETF SPY, SPY. Okay, what SPY is, again, it's an exchange-traded fund that holds the precise 500 stocks from the S&P 500 in exactly the measurements, the exact proportions as the S&P 500 index. That's what SPY is. Now, if you think through this is logical. Like, anybody can figure this out. This is not rocket science here. If I want to match the benchmark, and the benchmark is the S&P 500, why don't I just buy the benchmark? Wait, that's just too logical, isn't it? Yep, it is. It really is. It's simple. And you can use this for any benchmark. If you want to match the S&P 500, trade SPY. If you want to match the NASDAQ 100, you trade QQQ. If you want to match the Dow Jones Industrial Average, you trade DIA. Dow Industrial Average. How simple is that? If you want to match the Russell 2000 as the benchmark, if that's the benchmark that you want to match, trade IWM. There is an ETF for pretty much every benchmark out there. All you have to do is trade that ETF and you're matching the benchmark. Boom. Simple. And if all you want to do is match the benchmark, this is all you need to do. You don't have to pay a professional to do it. In fact, you can do this for free, 100% for free. You can take your retirement money, whether it's in an IRA, whether it's in a whatever it is, you can take that money, Move that account to a regular standard old broker like TradeStation or Charles Schwab or whoever you want to go to, and buy these benchmarks. They will not even charge you a commission to do it. Today, that's how easy it is. And you won't have to pay those bloody, fund manager fees. And you won't have to be opening up your statements to see, did they do good for me this month? Because you'll know you're in control. Now, matching the benchmark is nice. That's a good thing. But how can we beat it? How can we beat the S&P benchmark? How can we beat the NASDAQ benchmark or any other benchmark that you're trading? And the answer is we become more active. How do we beat the benchmarks? Well, number one, step one is we're going to trade the index ETF. Trade the index ETF. That starts us down the right road because now we're matching the benchmark. That's the first step, is to just match it, right? Step two is we become more active. We start timing the trades based on what you have been learning in the Pick Winning Stocks Challenge. Rebecca, I don't know if you're here today. You've been following me for a few weeks now. I know you're brand new to trading. If you're here, this is the easiest system you can ever start to implement. Trade just the index ETFs, and we're going to start timing based on the primary trends and the moving average system that you have been learning as part of the Pick Winning Stocks Challenge. And then there's one more caveat I'm going to put in here. Only take the bullish trades. Only take the bullish trades. And the reason, I've been kind of building to this, but the reason is, as I said a couple of days ago, the market is biased in a bullish direction. And as a result, we don't have the same binary moves down as we have up. So what happens is when we have a bear market, it tends to react very quickly. I'm going to show you an example in just a moment. It tends to react very quickly. On average, your average bear market is 3 months or less. Unless it's a 2008 type crisis, it rarely goes more than 3 or 4 months. 2022 was an exception, went a whole year. And that was actually a pretty big bear market. Most people don't remember it. Most people didn't even know it was happening. But it was a pretty good sized bear market, 2022. But a big, scary recession type bear market is a 2008. On average, those are 18 months to 2 years. The typical bearish market, the typical bear swing is 3 months or less. That's good to know, isn't it? So because of that, the moving averages don't really catch up fast enough. By the time everything happens for the bearish swing, it's almost too late to take a bearish trade. There's other techniques we can use to catch bear swings, but the moving average system itself is really fine-tuned for the bullish trades. And that's good. There's an intention to that. There's a reason for that, okay? What it means that this is your system, and it's really simple. We only trade the indexes. We trade based on the primary trends in the moving average system, and we only take the bullish trade ideas. Let me show you how that works out for us. Let's take one of the scarier moments in market history. This was the S&P 500 SPY in 2019 to 2020. The reason I'm using this is because it includes one of the scariest moments for most of you in market history, which was COVID. That was a scary time for lots and lots of people, right? During this time period, if you had purchased down here at $260 and sold based on our moving average system at $285, you would have made about $25 a share. If you then purchased back in around $285 after it crossed back above the averages and sold up here when it crossed back down, you're making another $15 a share. This one here in the yellow would have been basically a buy and sell again at $300, so it would have been a break even. Then we could have jumped back in around $300 as it crossed back up, sell up here at the top at $330. Not too bad, right? Notice what we did. We avoided all of COVID. All the pain of COVID was avoided. We get out. You can see where my sell bubble is. We actually got out as it's breaking below the averages right at the beginning of COVID. Now, here's the more magical part. After this huge sell-off, we jump back in at 285. We ride it all the way back up, 340. There's another trade in here, basically a break-even trade, buy and sell again around 340, and then we get back in around 340. During this year year and a half, however long it was, a moment that was very scary for the majority of market participants. A moment when I got new clients in the middle of COVID who were telling me that their financial planners had lost 70 and 80% of their portfolio. They're freaking out. During that same time window, with 5 trades, you would have had a profitable trade. 2 or 3 would have been break-even trades. You had a total gain of $145 per share, which represented a 60% return on your investment during a time period when most people were just freaking out. And most importantly, you would have avoided the emotional trauma of the 35% drawdown. Whoa. You do not have to go down with the ship. People are struggling right now. Right now, today, April 9th, 2025. This was 5 years ago, but April 9th, 2025, we're in the middle of a bearish swing. People are in a panic. Following this system, you avoided all this pain. Now, I come in and I do my market analysis every day, and we talk about this is kind of where we see the turns going, this is where we see the trends going. But you want the simple trading system, follow this trading system, and you avoid all this pain that we're in right now. I don't think I have any of my clients that have been following me that have been keeping up with our analysis that were bullish right now. Every one of them has been bearish or they're sitting in cash, avoiding the pain. How many of you would love to avoid the pain? It's easy to avoid the pain when you know what's going on. But if you don't know what's going on, if you've abdicated over to a so-called professional, or if you're just buying and hodling, letting it go until you're going to feel the pain. Because ignoring it does not solve pain. You got to get in there and understand what's going on. Using this exact technique over 1 year, it's a 28% profit versus an 11% profit. Over 2 years, 60% versus 53%. Over 5 years, you beat the market, you beat the benchmark, 133% versus 95%. It works. All we're doing is avoiding the pain and taking the most profitable part of the trade. That's easy. Anybody can do that. Let me give you some ETFs that you can use for this, and we'll put it in some more real world current market circumstances. You're going to use SPY. You're going to use SPY, that's for the S&P 500. You're going to use QQQ if you want to have the benchmark of the NASDAQ 100, and you're going to use DIA for the Dow Jones and IWM for the Russell 2000. These are the 4 primary ETFs that you're going to use to match and beat the market. Now remember, all you have to do is buy them and you match the market. You match the benchmark by simply buying them. If you buy them and you use the system that I just presented to you, you will beat the market and you will beat the so-called professionals. There may be a few moments in there where you slightly underperform for, a month or 2 at a time, but that's because you're in the middle of a turning point and you're just, things are uncertain. But then once the trends get going again, boom, you're back in and boom, you're far exceeding the market. Far exceeding. Okay. Now, if you want some leveraged ETFs, these are ETFs that move a little bit faster, have a little bit more money in them, more leverage, so you get better ROI. SPXL is a 3X fund for the S&P 500. TQQQ is for the NASDAQ 100. UDOW is for the Dow Jones, and URTY. URTY. These are leveraged funds for the primary indices, for the primary ETFs. And what they do is, basically if the market goes up 10%, these funds will go up, like in the case of the SPXL, this fund will go up 30%. So it's leveraged. It makes more money faster. The opposite is true as well. And the reality about these leveraged funds, if you're going to buy and hold them, I wouldn't do it. Just avoid that because the bear markets will wipe you out. But if you're going to manage it the way that I teach with the moving average system, these leveraged funds will actually 2x and 3x your profits, and it'll be great. You'll love the result if you learn how to do that right. Okay, so here's the strategy. Let's walk through the strategy. You're going to buy when the price is above the moving average and all 3 moving averages confirm. Hello? Haven't we been saying that all week? Yep. Buy when the price is above the moving average and the moving averages confirm. Step 2, we're going to sell when the price drops below the 50 moving average or when the 10 moving average crosses down below the 20. Those are your rules. Really simple, really straightforward. When the price is above the moving average and all 3 moving averages are confirmed, meaning they're crossed over, they're all going in the same direction, we're going to buy. When the price drops below the 50 exponential moving average, or when the 10 exponential moving averages cross down below the 20, we're going to get out. Now, you can play with this, you can tweak it, but this is the basic system. I promise it wins. And to give you an idea of how much it wins, every back test we've done on this, you can do this yourself. Go back with your historical replay. I taught you to do that last week. Go back and do that with your TradingView link. Do historical replay following this system. Let's say go from like June 2019. You'll trade through all of COVID, then trade the last 5 years with your historical replay. You should have about a 65 to 70% win rate just following these rules right here. But what you avoid is the big drawdowns. I mean, how nice is that? How nice is that to capture the big part of the trend and avoid the big, scary parts? It's easy. And to make it even more easy, what can we do? We use the Maestro moving averages, which I'm going to get rid of all of the other stuff on the chart, and I'm just going to show you the Maestro moving average right here on SPY. Wait a second. Why is it red? Because the price is below the average and the average is crossed down. Get out. I told you all of my clients at Trade Maestro, if they follow my system, 100% of them are out and they avoided this bear market. How many, just right now, how many of you are watching your retirement funds go down and you're literally like feeling like you're soiling your pants? How many of you are terrified to turn on the TV, open the computer, and see how bad is it today? And then you open it up and you're down 2,000 points. Or you open it up and today we're up 2,000 points because since we've been talking today, the Dow Jones, something must have come out. There's been some news bump. We're up 2,400 points. Why? Well, it's definitely not tariffs. Because some news event has come out, people are reacting positively, but there was a lot of money sitting on the sidelines saying, as soon as I can start buying, I'm going to start buying. And that's what you're seeing happening. We may see a combination of covering short positions. It may be buying new positions. Doesn't matter the why right now. Buying pressure is coming back in, and it's happening at that support level like we talked about. Okay? So that's what you're seeing play out in the day-to-day, but forget the day-to-day, forget the minor level trend, look at the big picture trend. If you followed this system over the last many months, depending on when you wanted to jump in, just pick a time. I don't care when you jump in. Jump in middle of 2023. We turned green. Can you buy when it turns green? Yes. Buy. Now we drop below the 50 period moving average right here. So that's where we sell. We moved back across with all 3 averages crossing right here. We buy. We drop below briefly right here. We sell. We drop back in here. We drop below here. We sell. We're back in here. We're out here as a small gain. So there's a buy, sell. Back in. There's a buy. We never dropped below the 50 period until we got here. Sell. Some of you jumped back in here and bought, and you sell here. 1, 2, 3, 4, 5, 6 trades. You should have 6 for 6 profits. You should have, but some of you, depending on execution efficiency, some of you may have broken even on that one and maybe broken even on that one. So you have 2 of the 6 that may have broken even depending on how well you executed it. But none of you, if you were following this system, using this simple indicator that's red and green, none of you would have been down right now from $600 on SPY down to $490. None of you would be down whatever that percentage point is. 20% or more on the NASDAQ. None of you would suffer that way. Let's look at the NASDAQ. Let's look at QQQ. Here's QQQ. Oh, it looks terrifying. Until my indicators load and you can see it's not terrifying. There we go. See, I told you I need the new graphics system because it's going to be faster. But here it is for the NASDAQ. Same thing. You would jump in here because it's green. Everybody knows green means go. So we're going to buy here. You don't get out until here. You buy again here because it's green. Get out here. Buy, sell. That one's a break even. Buy, sell. If you bought again here, maybe sell here, another break even. So again, you had 2 break even trades in here. One big profit. So let's see, let's just do some quick math here. 370. About 430 looks like. How many of you could survive making $60 a share per profit? $60 per share profit. Jump back in. It looks like it's around about the same price, $430. Now, some of you were thinking, oh, if I just buy and hold, I could avoid turning the trade. It doesn't matter because what you didn't realize is the reason you're getting out is not to avoid churning trades. The reason you're getting out is to avoid the pain. You see, that wasn't so painful, but you didn't know it wasn't painful. At the moment, back here in May, that moment that I just drew with the blue arrow looked exactly like this one over here. The one on the right turned into pain. The one on the left didn't. So what we're doing is we're preemptively avoiding the pain. Does that make sense? We buy at 430. We sell up here at about 470. $50 a share profit. This was a break even. We got in about right here and out at about the same price. That's around 470. Back in around 470. Again, you might be thinking, I'm just churning trades. It doesn't matter. It's not about churning or not churning trades. It's about avoiding the pain. And again, you don't know in the moment. You don't know if this moment here, which did look pretty scary, it dropped all the way down to 420. You don't know if that's going to be the moment where we sell off 25 or 30%. You just don't know in the moment. So you have to take your profit off the table, lock it in, play the game of risk management, and then jump back in when it's time to put risk on the table. This is how the profitable traders trade. Not the so-called professionals, the profitable traders. 510 was the next place we got out, so there's another $40 a share. Okay? And this was basically a break even, 520 and 520 up here. Okay? So we got $40 a share. I'm going to add up our profits. You ready? We got $40 a share right here. We had another $40 a share, and this was $60 a share. So during this time period from the end of 2023, November 2023, $140 per share profit. That represents, starting with 370, 40%. But we avoided the pain. If you had purchased at 370, let's say you put $100,000 in at 370, you would have ridden it up to 520, 530, and you would have been feeling really good about yourself because, you almost doubled this thing. You're up to, 100,000 becomes 170. And then last week, when it drops down to 420, you sell in a panic. And you ended up only making less money. If you sold in a panic last week, you would have made less money than you would have made on the very first iteration of this system. You can't tell me it doesn't work because I know we've been doing it for too long. It works. This is not just how you match the market. This will beat the market. This will beat the so-called professionals, and it's simple. It's simple, and because we created this tool for TradingView, it's as simple as red and green. Anybody can do that. Anybody can follow red and green, right? I think so. Most of you can. Okay, maybe there's a couple of you. If you're colorblind, then you change it to different shades, something you can see. Okay? All right. Now, you want to know how you can destroy all the fund managers who think they're so-called professionals? Well, before I do this, the fund managers who think they're so-called professionals, what they do, you'll have different disciplines. So some of these managers will be broad market. They're needing to match the S&P 500, and they fail. Most of them do. Some of these fund managers are niche. So they'll be emerging market managers, or they'll be managing a tech fund, or they'll be managing a different fund, and their benchmark is how does it compare to the S&P standard, which is the S&P benchmark. So those are sectors, okay? So if you want to beat the so-called professionals, here's all you have to do. Find the related S&P ETFs that track each sector. And I'll give them to you, actually. But just use those ETFs and follow the exact same system. Just find the matching ETFs for each sector and follow the same system. And here's what I want you to know. It works. It absolutely works. From time to time, over certain time periods, especially during sideways markets, there may be moments where the index outperforms. However, over the long term of the trend, the system will outperform over and over and over. You say, how do you know? Because I've been preaching this for years, and finally we started doing it live in our classes, and I want to share those results with you right now. Okay? Last year, well, shoot, I don't have the stats from last year. I should have had those. I'll tell you for this year, okay? So we have 2 ETF models that we follow every Sunday night. Both of them right now are in cash. I want you to know they're in cash. The most leveraged one is our SPXL model, and it is down $1,000 on a $10,000 account, so we're down 10%. That is less than the S&P 500. And the only reason we're down 10% on this is because we got whipsawed during one of the sideways moves up here. We got into it. Immediately we got punched out of it. It happened literally right at the beginning of the year. I can show you when it happened because we got in here and then we got out here. So that little whipsaw, because it was a leveraged fund. Remember, I told you the leveraged funds, you'll have 2 or 3 times the profit. You'll also have 2 or 3 times the loss. Because of that, we're down 10% in that fund. But if you consider where we would have been if you had not followed the system, where we would have been is here, because this is the trade. We got in back here, and we got out on the whipsaw. Actually, I think I'd have to go back and look exactly the dates, but I think we got in like right here and out here. So that accounts for it right there. But had we done that, and let's say we just purchased at, say, 185, last week we would be down, at $185 a share. Almost, not quite 50%, but we'd be pushing 50%. So we avoided, in this case, a 50% drawdown, and we were able to minimize the pain to only 10%, which is easy to overcome with this fund. This version last year, I think, did about 30 or 40% ROI. May have been more than that. It was a fantastic ROI. We compared both of them as one whole, and overall, it was about a 28% gain. So I guess my numbers are off because this one way outperformed. So my overall is about a 28% year over year, but I'd have to go pull those numbers. All right, here's our diversified fund. I want to show you this one. We've done several trades on it. This is the one where we go through the different sectors, and we're only down 2.9% on this one. 2.9% in the face of a market that has, since the beginning of the year, only whipsawed people and dropped down as a whole 15, 20, in the case of the NASDAQ trades, 25+%. How would you like to only be down 2% when everybody else is down 25%? Nobody wants to be down 2%. But here's my promise to you. My promise is by the next time I teach this, which will be, who knows, 3 or 4 months from now, that 2% loss will probably be looking at a 9 or 10, 15% gain, maybe more. And the SPXL account, it's probably going to be up 20%. Because I've done this enough to know. And I've watched how it all works. You say, well, what are those funds that you trade? I'm so glad you asked. I'm going to put them up here. You can screenshot it if you can. Here's the ETF list right here. I call them the X's: XLC, XLY, XLP, XLE, XLF, XLV, XLI, XLB, XLRE, XLK, XLU. We have an entire system for managing those. And when you do those, that diversified ETF model, which is what I call that, when you do that, you're only in 5 positions at a time. 5 only, and it's only the 5 best performers. And in a market like we're in right now, you stay in cash. And you're safe. And you avoid the pain. Now, I know 2%, you're like 2.9%, I don't want to be down at all. There's no free lunch. You can't completely avoid all the pain. But to be down 2 or 3% when everybody else is down 10 times that, that's pretty remarkable. And that's called beating the market. That's what your fund managers can't do. Your fund managers are out there right now telling people to buy more. Oh, you're in a lot of pain. Buy more. It's all on discount. Well, maybe it is on discount. Maybe it is the right time to buy. Or maybe we're going to drop another 15 or 20%. See, I don't know, and you don't know. I don't have a crystal ball. You don't have a crystal ball. All we can measure is we can trade the trends as they are happening. And trading the trends as they are happening, we can avoid the pain. It takes somebody who's arrogant enough to believe that they can look at the statistics and they can read the numbers and they can guess what the future value should be, to say, buy in the face of all of the pain. And the statistics have shown us over time, those people tend to be wrong. That's the stats. 93% cannot match their benchmark. So either you have a top 5, 6, 7% fund manager, or you're out there with everybody else just losing your money. And that's not what you want. That's not what I want for you. Okay? All right, I have shared it with you. I've given you the model. How do you match and beat the market? How do you match and outperform the so-called professionals? I have given it to you. Incredibly valuable information I just shared with you. If you got any questions, please type it in here. Greg has switched back to YouTube. He says he couldn't get Rumble to work. Oh my goodness, that's terrible. Well, we got a handful of people over on Rumble, and Abe is here from Detroit, Michigan over on Rumble. So Abe, if you're still here, great to see you. Thanks for jumping in here. Ladies and gentlemen, that is all I've got for you today. Tomorrow, we're going to take it one step further. We're going to continue building on this. But I think we've already had a pretty extraordinary week, don't you? Last week in the Pick Winning Stocks Challenge, we learned how to identify the structure of the trade. We learned about the trends. We learned how you profit with that. This week, we start moving into strategy. We got 2 more days that we're going to talk about some strategic ideas. And then next week, we're going to be getting into risk management and how we avoid even more pain. Okay. Sometimes I show you some stuff about avoiding pain, and like that's maybe still more pain than you want. That doesn't mean that that's the best we got. It just means that at this point of the system, the point of laying things out for you, this is where we are. If you have not done so already, like and subscribe to our YouTube channel. If you're over on Rumble, please follow. We're trying to get ourselves up there to the number where we can get our own custom URL, and we are almost there. It's a pretty low benchmark, but we started pretty much from scratch. So it takes a little bit of time to get a little bit of following going over there. So if you're over on Rumble, please like and subscribe, follow. I think it's what they call it over on Rumble. If you're over on Facebook, please follow and subscribe over there as well. And ladies and gentlemen, that's what I've got for you today. Tomorrow, we will be back, same time, same place. And if you haven't done it already, in the descriptions here, it is in the descriptions, but in the chat, I put a link to download the 3-step download the Ultimate Trading Cheat Sheet, which includes all the 3-step systems, and it's a 4-page ETF, includes the trading checklist and all the stuff that I kind of talk about in this program. So it's all right there in the Ultimate Trading Cheat Sheet. Just click there in the resources and you can download that. All right, folks, I wish you all the best. I hope you have a wonderful afternoon. Until tomorrow, I wish you the best. Happy trading, and we'll talk to you soon. Have a great day.